Imagine a world where people are used to living paycheck to pay for their day-to-day lives. But things get so bad in their economy that they no longer can survive from paycheck to paycheck. In fact, they have to use money they haven't earned yet from the future and draw down on that future capacity to work and pay it off today. We call that debt. We call that credit card debt specifically for everyday people. And so with the credit crunch around the corner, people have to actually use their credit card more than ever. And that's just for day-to-day living. In this video, we're gonna get into that and so much more. You've reached the Financial Almanac. I'm Basil. Let's get straight into this. Borrowing standards for so many of us in our society here in the West have completely contracted. They've tightened so much that now, personal line of credits, secured loans, revolving or non-revolving access to credit is more difficult now than it has been in so long. It's so difficult for people to qualify for these loans because one, their wages has not gone up as much as the rest of the market has outside of wage growth, right? So their incomes, when they bring it to their banker, don't qualify to draw down according to their income to debt ratio to qualify for an increased loan. And depending on their history as well, sometimes they might miss a month or two and that would affect their credit rating. And with the credit crisis that's coming right after this interest rate crisis, it's going to be very tough for people to make ends meet. With the recent moves from Jerome Powell and the Federal Reserve for nearly 14 months, with 10 consecutive interest rate hikes, the consumer, what are they to do other than to borrow money because they're not making enough at work? So they draw down on their credit card, not for, lavish spending and going out. Most Americans and most Canadians as well are actually paying it at the grocery store for their day-to-day supplies. That is a tightening noose around the general economy because if you have to borrow just to make ends meet, that's not a good sign. That's actually a very difficult sign to swallow because if things get even worse and they contract and prices continue to go up while our wages do not match that rate of growth that prices are going up at, let's just say this, when there's inflation in society and that same economy is in a recession, that is one of the worst ways an economy can be in, and that's called stagflation, where things get more pricey, but everyone needs cash. It's the worst of both worlds. And with the Federal Reserve meeting coming in June 14th, whether or not they will increase rates, which I personally think they might. I think they might bring it up to 5.5 from currently 5.25, which will make it even more difficult to borrow money for not only businesses, but also for personal people. Okay, so I want to get into why consumer debt has skyrocketed over the past several months. And so with access to credit now being the tightest it's been in a very long time, credit card debt has never been this high. It's almost approaching $930 billion where people have to borrow to make ends meet. Now there's a liquidity crisis, meaning people want cash. And when people want cash in their hand and in their possession, that leads to a financial crisis. Now more than ever, the dollar in your pocket will be highly valued because everything is being sold off. If the market corrects, whether it's commercial real estate or regional banking or the stock market or your ETFs or your portfolio or your pensions, if that corrects and it goes back down, you're gonna want cash. You're gonna want that dry powder. But what if people don't have dry powder? What are they to do to make ends meet and pay their bills and pay for groceries? Well, they're going to their credit cards. And now, at an all-time high, $930 billion in credit card debt is an all-time high. We've never seen this before. And it's not because of luxurious spending or shopping for thrifty stuff. It's literally to make ends meet, to pay for gas to go to work, right? And that might not be secure anymore, considering the unemployment rate might definitely go up, considering how many layoffs are happening in our economy. And, then you go to the grocery store, you swipe, you want to collect those rewards. Great. But guess what? You don't have the money to pay that off. We're reaching an all-time high. People don't have cash to pay for their day-to-day needs. What happens if you can't pay for your utilities? You're going to shut off your electricity? What happens if you can't pay for your rent or your mortgage? What are you gonna do? You're gonna have to sell your property or you're gonna have to downgrade your standard of living. And so when we have credit card debt at an all-time high and delinquencies are also rising on that credit card debt, that's not a good mix. That's not a good outlook, right? And things are only gonna get more hairy from here. So if we've seen consumer debt, the highest it's ever been in the last 15 years, month over month is still progressively getting higher and higher, that means the last 10 rate increases in the last 14 months from April 2022 has basically done very little to help the common people, right? It's only making things even more tighter, because if we're racking up debt, what are people to do to make ends meet? Today, we see 20 and 30-year-olds are the ones who are carrying the largest and pushing up the credit card debt more than ever to make ends meet at the grocery store or their day-to-day activities is actually increasing. Now imagine you have to pay 20% interest rates on using your credit card so you can buy groceries, so you can have food on the table and shelter around you here in the first world country. How shameful is that if your government has let things move to the point where 20 and 30-year-olds, the next generation of leaders and people in our economy, have to borrow against their own future to make ends meet. And if delinquency rates are going higher, it's only going to get even more ugly for the whole country. You know, the Federal Reserve just last week, right, early May, have released a consumer credit report saying that $26.5 billion was added to the credit card debt just from March to April in 1 month. April 2023 to last year, 2022, that 1 year where there took place 10 increase rate hikes, you know, from 0.25 to today's interest rate at the Federal Reserve of 5.25, that was a 6.6% year-over-year increase from 1 year ago. How is debt increasing when interest rates are going higher? Because people are desperate. Isn't interest rates supposed to contract the amount of money that people borrow? Yes, but if they have nothing else, they're going to go to credit card and buy food at 20% interest rate on their credit card because they can't make ends meet. So after 1 year of increasing rate hikes, we're still paying more at the gas station, at the grocery store, and we're putting that on our credit card because there isn't enough jobs out there to sustain everything. There isn't enough money in our savings and checking accounts because the market has corrected. As of recent reportings and everything that we've covered so far, this brings the US consumer economy, the consumer debt, to $4 trillion in total. $4 trillion, oh my God, $4 trillion in total in consumer debt alone by the public. And it only gets worse from there. It's only gonna keep rising. And with rising interest rates, which I do believe Jerome Powell will do in June, contrary to what a lot of people believe they might pause, I actually believe he might raise. With that happening and credit card debt just piling on, banks are gonna basically be transferring that risk onto credit card rates, and they might increase you from 20% to 25%. They have the discretion to exercise that right if they wanted to. And what are people going to do? They have no option. They have to make ends meet. They have to put food on the table, pay for utilities, protect their loved ones. As more economic conditions get tighter and more challenging, the more delinquencies, overdue bills, and invoices will be coming into everyone's mailbox. With household consumer debt being the highest it's been in a very long time, we see that 20 and 30-year-olds are trying to make things better for themselves, but it's not strictly for them alone. We also see this in the 40s and 50s as well. It's very challenging today to put food on the table for so many people, especially when there might be a supply crisis as well around the corner. That hasn't happened yet. But if the economy contracts to the point where I believe it might be really ugly. We see that the Federal Reserve monetary policy isn't apparently working, because if in the last 10 rate hikes, right, from last year till today, and debt is still going up at the rates that they're going on, where we're breaking records left, right, and center in terms of consumer debt, household struggling to keep things together, making ends meet. What makes you think that the monetary policy that they're pushing forward is good for us? It might push us into a recession, stagflation, and it might be a very difficult 5 years if things continue to go the way they are. You know, TransUnion recently had a report, right, where the US consumer for credit card debt has jumped by 20% in the last quarter. They also share that 26% for unsecured loans. personal unsecured loans has also increased in the last quarter, 26%. Revolving credit, 20% for credit cards at a higher interest rate. Makes sense that if anyone had access to unsecured personal loans at a lower interest rate than generally on a credit card, that jumped up to 26% in 3 months in last quarter report. That is huge. And with delinquencies higher than they ever been, who's going to be holding the bag on that? You know, TransUnion, this privately owned, business-oriented credit reporting agency, is correct, where revolving credit are increasing that much. That pretty much shows us that we're not living paycheck to paycheck anymore. We're going from monthly invoices to monthly invoices on our credit cards, on our revolving credit. So we're not waiting for the check that's coming. We are spending the future checks. So we're going from future checks to future checks, and we are impoverishing ourselves in the future just to make ends meet today. That's what it means. Not only has US credit card debt approaching $920 billion from this last, 20% increase from last quarter, the unsecured personal loans from last year, after the 26% increase, that adds $225 billion of debt to the consumer household. In addition to the $920 billion in credit card debt. That's a lot of debt on debt on debt. Now, having said all that, the financial outlook isn't looking too good. With increased prices in our society still remaining very high, people are still gonna have to draw down more on their credit card, more on their unsecured loans, and it's only gonna get more dire, I suspect, especially if we do end up in a mild recession or even worse. A few decades ago, the US household median income was about $77,000. Today, the US household median income is just shy of $71,000. Yes, that means even though in the past they got paid more and things got more expensive in our society as time progressed, we make less than our ancestors, well, not ancestors, the generation right before us. Having said all of that, in the last quarter, those numbers I shared you, the average American has increased their credit card debt by $5,700 around there. And their unsecured personal loan has increased by just above $11,000. This is a tough economy. And if we do enter a recession, it's going to be a nightmare because the amount of bankruptcies and delinquencies that's going to be around the corner and just the loss of faith is going to be unmatched. I don't think we've ever had this kind of fear in our society, especially with a debt to the GDP ratio that it's ever been at 120%. And I only think that's only going to get worse now with, how things are going to be in our economy. People cannot skip on rent. People, cannot skip on cars. And so with car prices and rent being not even close to pre-pandemic levels, everything's so overvalued today. What are people to do? And the saddest thing is this isn't just localized to, say, the United States. This is happening in Canada, in Australia, in the UK, which is Ireland, it's Wales, Britain. It's happening in Germany. It's happening in France and Italy. You name it, it's happening there. South Africa, Brazil, Chile. It's happening in China, Japan, South Korea. You name it. It's happening in Pakistan, India, Malaysia. You name it. All these countries are being affected. This is a global pattern that we are seeing in all of the world's financial economies, where things are getting more expensive. People are making less monies. The monetary policies by the central banks are not helping the bottom line for people. Now, for people that do have some cash, access to liquidity, right, in their checking or savings account or in their short-term money markets or treasury bills, there's going to be an even more banking crisis situation happening in the future as people are going to be fighting for liquidity. They're going to want their cash. And that for me is the definition of a financial crisis where everybody wants their money, right? And so with this slow bank walk, it might progress into a bank run where everyone's going to be there in person to wait in line, to talk to the teller, to take out their cash in person. Because it's such a large amount, they can't just easily call up their banker and ask them to do that. They're going to say, oh, you're going to have to come down and join the line and have access to this. And then guess what happens? Oh, we're out today. We will order it. The bank's tellers will say this, and then people will be like, oh, okay, we're going to put in an order right away. As soon as we get it, we'll let you know. And then they get a call a couple days later saying, the institutions unfortunately don't have enough money printed out, so we're gonna have to wait on that. And then there's a whole thing, kicking the access to cash and our deposits down the road as, the bankers are trying to figure out what the hell to do. And so this banking crisis, I don't think has actually stopped. I think it's going to continue, right, from what I've shared. But also just last week, the Federal Reserve has shared that $13.8 billion of depositors in their banks have also left. This is huge. People are putting their money in money markets. So smaller banks are adding even more pressure. Their bottom line, their profit to earnings ratio, everything's just going to be demolished. The confidence in smaller banks is completely evaporated. The amount of loans that are also being delinquent and canceled is on an all-time high. Things are very difficult out there. So make sure you protect your assets and you have access to what you've done. Prepare yourself, because the next little while is going to be very challenging. I do suspect that the regional banking crisis is going to continue to collapse. We just see the numbers come out and it's just looking worse and worse as the weeks go by. So the broad strokes are this: small businesses, the heart of our economy, the backbone, spine of our infrastructure, is going to have the most amount of pressure it's ever experienced in history. Not only will there most likely be a large amount of layoffs, increasing the unemployment rate, there's also going to be a huge cutback on people that do keep trying to say, hey, if you want to remain employed, you got to take a pay cut. Not only that, the supply and services that they will do will have less staff to service that as well. That increases the amount of people being delinquent, because if unemployment goes up, there's going to be even more delinquencies in our economy. And so when people do flood the job market looking for work because they got recently unemployed, guess what happens to any access to cash they have in the stock market? They're going to have to sell to make ends meet, to pay off that credit card debt that they didn't want to do. They did not want to sell their shares in their old company, the employee shared purchase plans that had access to. They did not want to sell their pensions and in their accounts, but they will have to have access to that cash. What do you think that'll do on a systemic level when people start doing this? Right? It's going to bring down the stock market. Initial jobless claims have risen more than actually expected since the fall of 2021, like around November 2021, when the market was booming and people could stay home because their assets were doing so good. They didn't need to work, and employers were saying, hey, we'll give you so much money to come work for us. During that time, remember that in November 2021? Now we're at the other side of that coin, where unemployment rates are slowly increasing in jobless claims, but it's for the other reason. Rather than sloshing around all this cash, people need cash, but small businesses can't keep up. There's fewer employers now that are willing to provide people full-time jobs with full benefits, and there's increasing amounts of businesses that are saying, instead of full-time, we'll offer you guys part-time jobs, and people have no choice. They have to take 2 part-time jobs to basically cover what they used to get in full-time, except they don't get a lot of the benefits and even a pay cut here and there. If unemployment rates are only going to rise, especially with the June meeting, where I suspect they're going to be increasing rates, that unemployment rate is going to skyrocket. This is the last leg down. When unemployment rates increase to the point where I'm worried they may hit around 5%, 6%, guess what happens? Inflation gets destroyed, but so does everything else in the economy. Everyone is starving for cash so they can pay for things, just to have access to it. Yes, prices might go down because of the rarity that the US dollar will experience. It'll increase in its scarcity, meaning everything else will be a little bit more affordable because prices have to drop. Nobody's spending anymore because there's no cash to go around. Not only will I suspect that the federal funds rate will be increased in June, before that, the US Congressional Office has also said that they expect the national debt to increase to $1.5 trillion. Now, if the Congressional Budget Office is correct and the national debt will increase by 1.5 at the end of this year, 2023, that is going to be terrible for the economy, because just like credit card consumers and household consumers, the government in and of itself is borrowing and using more money to spend in our economy in things that, are, I'm not going to get political, but essentially the bottom line is they're not making as much. We see tax revenues that has depreciated. If you're not making as much, how are you spending even more? That's a bad way to go about it. I remember not too long ago in February, right, the CBO, the Congressional Budget Office, said that they estimate that $1.4 trillion will be added to the national debt. Today, right, in May, They've increased that to 1.5. You know what the difference is? That's $100 billion with less tax revenue. Where are they going to get the money from? We barely can service the debt as itself, let alone the actual principal on that balance. If we can't even service the debt on the interest rate, on that principal balance, why are we spending more? Let's cut back on, damn, it's crazy. It's crazy. You know, with this increase in the national debt that they just proposed, $75 billion is going to student loans. $33 billion is going to depository insurance, and $25 billion is going to service the interest rate. That's a lot of spending for things that we basically need in our economy. The student loan thing is a debatable hot issue. Let me know where you stand down below. I'm not going to touch that. So having covered quite a bit of our consumer problem today with the inflation rate and the federal funds rate potentially increasing, things are going to get a lot more challenging right now. So we do need liquidity. We do need cash more than ever. So if you have an employed shared purchase plan, right, with the EPSP, make sure to sell some of that stock. You don't have to transfer it into your checking account so you pay taxes on it. Keep it in your retirement account, but just convert it to cash. You know, so that way you can buy lower when the economy does have a recession in the future. If you are not in that and you do have access to other stocks, take some profits if you're in the green. Please do take as much as you can and don't be greedy, because if the market does drop by 20 to 30 to even 40%, you're gonna wish you have sold today in order to purchase things a lot cheaper in 6 months from now. Having covered a lot of this, tomorrow I will be talking about the debt ceiling crisis that Janet Yellen and other Federal Reserve members have touched upon, and I'll share you what my consideration is regarding the default that has already taken place in the past but nobody's talking about. So make sure to like, comment, and subscribe for that video and so much more financial insights here at the Financial Almanac. I am Basil, and I'll talk to you guys tomorrow. Bye-bye.